Stop scrolling. Stop breathing. Stop whatever insignificant task your mind was about to wander toward. Because in the next 17 minutes, everything you thought you understood about your financial future is about to be dismantled, rebuilt, and transformed into something that could either save you or destroy you. The choice will be yours, but only if you stay until the very end. I need you to understand something before we begin. What I am about to share with you is not entertainment. It is not speculation dressed up as analysis. And it is certainly not another recycled prediction from someone trying to sell you fear in a bottle. What I possess, what I am holding in my hands at this very moment, is a weapon. It is a financial weapon that was forged in the deepest, darkest boardrooms of Wall Street. And it was never, under any circumstances, supposed to reach your eyes. 72 hours ago, while you were sleeping, while you were commuting to work, while you were scrolling through social media completely unaware of the seismic shifts occurring beneath your feet, a document was transmitted through the most secure channels in the financial world. It traveled through encrypted servers, past firewalls that cost millions of dollars to construct, into the private terminals of individuals whose net worth exceeds the GDP of small nations. This document originated from Morgan Stanley, not just any department within Morgan Stanley. It came from the inner sanctum, the commodity trading desk, the nerve center where decisions worth billions of dollars are made in the time it takes you to blink. These are the people who don't react to markets. They move markets. They are the puppet masters. And for decades, the rest of us have been dancing on their strings without ever seeing the hands that control us. But 72 hours ago, something changed. Something so significant, so terrifying, that even the puppet masters started to panic. And when the puppet masters panic, the entire theater burns. The document I am referring to is an internal memo. 3 paragraphs, 417 words. That is all it took to trigger what I can only describe as a controlled evacuation of the silver market. Not a gradual repositioning, not a strategic rebalancing, an evacuation, the kind you order when the building is not just on fire, but when the fire has already reached the load-bearing walls. And the structural engineers are telling you that collapse is not a possibility, but a mathematical certainty. The memo was addressed to their most elite institutional clients. We are not talking about millionaires here. Millionaires are noise to these people. We are talking about the sovereign wealth funds that manage the treasuries of entire nations. We are talking about hedge funds that move enough capital to crash currencies. We are talking about family offices that have been accumulating wealth for generations, dynasties that have survived world wars, depressions, and revolutions. These are the top 1% of the 1%. The people who don't just have a seat at the table, they own the table, the chairs, and the building the table sits in. And Morgan Stanley told them to run. The subject line of the memo contained 3 words that should make every cell in your body vibrate with attention. Exit all positions. In the sterile, calculated language of Wall Street, those 3 words are not a suggestion. They are not a recommendation to consider. They are a 5-alarm fire. They are a declaration that the ship is not just taking on water. The ship has already slipped beneath the surface, and those 3 words are the last desperate signal flare shot into the sky before the lights go dark forever. Think about what it takes for a bank like Morgan Stanley to put something like this in writing. Every single syllable in that memo was reviewed by armies of lawyers whose hourly rates exceed what most families earn in a week. Compliance officers who have spent their entire careers avoiding exactly this kind of liability pored over every word. Risk management teams ran simulation after simulation, calculating the probability that this memo could leak, could be used against them, could expose them to lawsuits that would make their legal fees look like pocket change. And they sent it anyway. They sent it because the alternative was worse. They sent it because their internal models, their proprietary algorithms that process more data in a single second than you will encounter in your entire lifetime, told them that staying silent was no longer an option. The risk of warning their clients and being wrong was calculated. The risk of staying silent and being right was catastrophic. They chose to warn. And in making that choice, they revealed something that they have spent decades trying to hide. The silver market is broken. Not bending, not stressed, broken. And the people who broke it are now running for the exits before the rest of the world realizes what they have done. I have spent the last 72 hours verifying this memo through multiple sources embedded deep within the institutional trading world. I have spoken to people who have spent their entire careers in the shadows of these giants. I have cross-referenced the claims in this document with publicly available data that, when you know where to look, confirms everything. What I am about to share with you is not rumor. It is not speculation. It is the most important piece of financial intelligence you will receive this year. Perhaps this decade. Perhaps in your entire lifetime. Morgan Stanley has given you a 72-hour head start. The question is whether you will use it. The exits are still open. The crowd has not yet realized the building is on fire. But the smoke is rising, and soon, very soon, there will be a stampede. When that happens, the doors will jam, bodies will pile up. And those who hesitated, Those who waited for one more confirmation, one more piece of evidence, will be trampled beneath the feet of those who understood the warning and moved. You have a choice to make right now. Lean in, and let me show you exactly what Morgan Stanley knows. Let me show you why they are running. And let me show you how to position yourself on the right side of the greatest wealth transfer in modern financial history. Let me take you inside this document. Let me dissect it word by word, phrase by phrase, so you understand not just what it says, but what it means. Because in the world of high finance, the true message is never on the surface. It is buried beneath layers of carefully constructed language, coded terminology, and deliberate ambiguity. But if you know how to read between the lines, the message becomes clear. And it is terrifying. Paragraph 1 opens with what appears to be standard risk disclosure language. It references extraordinary volatility in the silver derivatives market. Now, to the untrained eye, volatility is just a fancy word for price movement. Markets go up, markets go down. That is volatility. Nothing to panic about. But that is not what this means. When Morgan Stanley uses the word extraordinary, they are not describing magnitude. They are describing abnormality. They are saying that what is happening in the silver market right now does not fit within any historical model they have ever constructed. But the second phrase in paragraph 1 is where the real warning is embedded. They reference structural changes in the silver derivatives market. Structural changes? Let those two words sink into your consciousness. In financial terminology, structure refers to the foundational rules that govern how a market operates, the mechanics of price discovery, the relationship between buyers and sellers, the infrastructure that allows trades to settle, positions to clear, and contracts to be honored. When you say a market is experiencing structural changes, you are saying that the fundamental architecture is shifting. The rules that have governed this market for decades no longer apply. It is like being told that the laws of physics have been suspended in a particular room. Gravity still works everywhere else, but in that room, objects float. You cannot predict what will happen. You cannot model the outcomes. All you can do is get out before the ceiling collapses or the floor disappears. Morgan Stanley continues in paragraph 1 by specifying exactly what positions must be closed. They list COMEX silver futures, options on futures, over-the-counter silver swaps. This is not a selective recommendation. This is a blanket directive to abandon every single form of paper silver exposure that exists. They are not telling their clients to reduce risk. They are not suggesting a partial hedge. They are demanding complete and total evacuation from anything that even remotely resembles a claim on silver that is not physical metal in your direct possession. Paragraph 2 introduces the element that separates a warning from an alarm. It specifies that this recommendation applies to all position sizes and all expiration dates. In normal circumstances, risk management is surgical. You might advise closing positions that expire soon while holding positions that expire later. You might suggest that smaller positions can be maintained while larger positions are reduced. That is how professional risk management works, gradually, methodically, with precision. But this memo abandons all surgical precision. It is scorched earth. Close everything, regardless of size, regardless of expiration. The only criteria for liquidation is existence. If the position exists, it must be terminated. Then comes the phrase that tells you everything you need to know about the severity of what Morgan Stanley sees coming. They instruct clients to prioritize orderly liquidation over price optimization. Translation: we do not care if you lose money. We do not care if you have to sell at a discount. We do not care if the market is illiquid and you cannot get a fair price. Just get out. Get out now. Get out at any price, because whatever is coming is infinitely worse than any loss you will suffer in the exit. In Wall Street terminology, price optimization is everything. The entire industry exists to extract the maximum value from every transaction. When a bank tells you to ignore price optimization, they are telling you that survival matters more than profit. They are telling you that the normal rules of engagement have been suspended. They are telling you that this is a life or death scenario for your capital. Paragraph 2 concludes with a deadline. All positions should be closed by the end of this month. Not a suggestion, not a target, a hard deadline. The end of the month. That gives clients approximately 3 weeks. In normal markets, that would be an eternity. You could liquidate almost any position in 3 weeks without causing a ripple. But this deadline reveals that Morgan Stanley believes the window of orderly exit is closing rapidly. They are giving their clients the maximum time they believe is available. After the month ends, the exits will be blocked. Then we arrive at paragraph 3, the nuclear paragraph. This is where Morgan Stanley stops simply advising their clients and starts confessing their own actions. They state that the bank itself will be reducing its proprietary exposure to zero over the same time frame. Morgan Stanley is not just telling others to leave. Morgan Stanley is leaving. They are abandoning their own positions. They are walking away from one of their most profitable trading desks. But the final sentence of paragraph 3 is the most chilling of all. It states that Morgan Stanley will not be accepting any new silver-related business until further notice. A global bank exists for one reason and one reason only: to generate fees. Every trade, every swap, every contract represents revenue. When a bank says no to new business, they are not being cautious. They are being terrified. They have calculated that the potential revenue from new silver business is not worth the risk of exposure to whatever is coming. They would rather burn their paycheck than be standing in the blast radius when the detonation occurs. That tells you everything. That tells you that the people with the best information, the deepest pockets, and the most sophisticated models have looked at the silver market and concluded that it is uninvestable. Not risky, not volatile, uninvestable. When Morgan Stanley walks away from money, you should be running. Now you understand what the memo says. But understanding the words is not enough. You need to understand why. You need to see what Morgan Stanley sees. You need to look into the abyss they are staring into and understand why they have decided that the only rational response is complete and total retreat. What they see is not a single problem, it is a convergence. 3 simultaneous crises that are colliding at this exact moment in time. And when they intersect, the result will be an explosion that reshapes the precious metals market forever. Let me show you each crisis in detail. Crisis number 1 is the inventory depletion, and the numbers should make your blood run cold. The COMEX, the primary exchange where silver futures are traded, maintains a vault system where physical silver is stored. This inventory is divided into 2 categories. Registered silver is metal that is available for delivery against futures contracts. It is the actual physical supply that backs the paper promises trading on the exchange. Eligible silver is metal that is stored in the vaults but belongs to private parties and is not available for delivery. The registered silver inventory has collapsed. It has fallen below 30 million ounces. 30 million ounces might sound like an impressive number to the average person, but in the context of global silver demand, it is a rounding error. It is the lowest level we have seen in over a decade. But the absolute number is not what has Morgan Stanley reaching for the emergency alarm. It is the velocity of the decline. 6 weeks ago, that same registered inventory stood at 43 million ounces. Do the math. That is a loss of 13 million ounces in 42 days. That averages out to more than 2 million ounces of physical silver vanishing from the vaults every single week. 2 million ounces gone every 7 days. If you extend that trajectory, the registered inventory reaches 0 in approximately 15 weeks. But markets never move in straight lines, they accelerate. In the last 14 days alone, the vault has lost nearly 5 million ounces. If that accelerated pace continues, we are looking at complete depletion in 8 weeks or less. And when the vault hits 0, the entire paper silver market becomes a fiction. You cannot deliver metal that does not exist. You cannot honor contracts with promises. The skeptics will immediately point to the eligible category. They will say there is still over 200 million ounces of silver sitting in the COMEX vaults. They will argue that this metal can simply be transferred to the registered category whenever it is needed. But here is what they do not understand. That eligible metal does not belong to the exchange. It belongs to private institutions, wealthy families, and funds who are using the vault purely for secure storage. They have no obligation to sell. They have no incentive to sell. And with physical premiums exploding in Shanghai, London, and Dubai, why would they sell their metal to COMEX at the manipulated paper price when they can ship it overseas and receive a massive premium? They will not sell. The eligible inventory is a mirage. It looks like a backup supply, but it is a private hoard that will not be released. The registered category is the only buffer the system has, and it is evaporating before our eyes. Crisis number 2 is the explosion in delivery requests, and this is where the mathematics of the situation become truly impossible. To understand this crisis, you need to understand the fundamental lie upon which the entire silver market has been constructed. The silver futures market is not really a market for silver. It is a market for promises. For every 1 ounce of actual physical silver backing the system, there are hundreds of ounces of paper claims trading hands. The ratio, at various points, has exceeded 300 to 1, 300 paper ounces for every real ounce. The system only functions because the vast majority of traders never actually want the metal. They are speculators. They bet on price movements. When their contracts expire, they either roll them into the next month or they settle for cash. Only a tiny fraction, historically around 4 to 5%, ever demand physical delivery. But that fraction is growing. And it is growing at a pace that terrifies the banks who are short. In the last delivery cycle, over 8% of open interest stood for delivery. That is nearly double the historical average. And the preliminary data for the upcoming month suggests that the number could reach 12 to 15%. Let me show you the arithmetic of disaster. There are currently approximately 165,000 open contracts for silver on the COMEX. Each contract represents 5,000 ounces. That means there are paper claims on 825 million ounces of silver floating in the system. If 15% of those contract holders demand physical delivery, The exchange must deliver 123 million ounces. But remember, there are only 30 million ounces in the registered vaults. You cannot deliver 123 million ounces when you only have 30 million. It is not a matter of scrambling to find more metal. It is not a matter of raising prices to incentivize sellers. It is mathematical impossibility. The metal does not exist. When that moment arrives, the COMEX will have two choices: default on their obligations or change the rules of the game. Morgan Stanley has seen this movie before. They know exactly which choice will be made. And they are positioning themselves to be on the winning side when it happens. Crisis number 3 is the silent killer that almost no one in the mainstream media is discussing. It is counterparty risk, and it is the crisis that could bring down not just the silver market, but the interconnected web of global finance that depends on it. Beyond the public exchanges like COMEX, there exists a massive shadow market for silver. This is the over-the-counter derivatives market, where banks, hedge funds, and institutions trade directly with each other without public price discovery, without transparent reporting, and without the oversight that governs regulated exchanges. Estimates suggest that the notional exposure in this shadow market is between 5 billion and 10 billion ounces of silver. To put that in perspective, the entire annual mine production of silver globally is approximately 800 million ounces. The shadow market contains claims on 6 to 12 years of global silver production. And much of this exposure is held by entities that are short. They have sold silver they do not actually own. They are betting that the price will fall, that they will be able to cover their positions cheaply, that the game will continue indefinitely. But the game is ending. As the price of physical silver begins to disconnect from the paper price, as premiums explode and the relationship between reality and fiction becomes undeniable, these short positions are starting to hemorrhage. Every dollar increase in the silver price represents billions of dollars in losses across the shadow market. And Morgan Stanley can see exactly who is bleeding. They are part of the interbank lending network. They see which banks are drawing down their emergency credit lines. They see which hedge funds are scrambling to post additional collateral. They see which family offices are quietly liquidating other assets to cover margin calls on silver positions they never expected to go wrong. What they are seeing is a system under extreme stress, with multiple major players approaching the breaking point. Here is the nightmare scenario that Morgan Stanley's models have identified. If just one major player in the silver space fails to meet a margin call, the contagion will spread instantaneously. In the modern financial system, every bank is tied to every other bank through a web of derivatives, lending arrangements, and counterparty agreements. If Bank A collapses because of a silver short position, Bank B suddenly has a hole in its balance sheet. If Bank B was already stressed, that hole could push them over the edge. Then Bank C, which had exposure to both A and B, faces its own crisis. This is the domino effect. And Morgan Stanley has looked at the board and concluded that the first domino is already wobbling. They do not want to be anywhere near it when it falls. They are exiting now while the exits are still orderly, so that when the counterparty collapse begins, they are already standing safely on the sidelines, holding cash, watching the destruction from a distance. But these three crises are not happening in isolation. They are feeding into each other, creating what financial modelers call a doom loop. And once a doom loop reaches critical velocity, it becomes exponential. It becomes unstoppable. Let me show you how this feedback cycle works. It starts with falling inventory. As the public sees vault levels dropping week after week, nervousness spreads. People think that if silver is running out, they should get theirs before it is gone. So more people demand physical delivery. This drains the vault faster. As the vault drains, the banks that are short silver realize they are trapped. They cannot find metal to cover their positions at current prices, so they start buying silver on the open market. But their buying pressure pushes the price up. As the price rises, more people want to buy silver as a store of value, as protection against inflation, as insurance against system failure. This increases demand further, draining inventory faster. At the same time, physical premiums explode. When a dealer charges you $40 for an ounce of silver that the paper market says is worth $30, that premium is screaming that the paper price is a lie. And when people see that divergence, they lose faith in paper entirely. They abandon futures and ETFs and demand physical metal. This creates more delivery requests. More delivery requests drain the vault further. The vault drains, banks panic, they buy to cover, prices spike, premiums explode, more people want physical, the vault drains faster. Round and round the cycle goes, accelerating with each revolution, until the system cannot contain the pressure and it simply explodes. Morgan Stanley's proprietary models have mapped this doom loop with mathematical precision. They have identified the point of no return, the moment when the cycle becomes self-sustaining and unstoppable. And according to their calculations, we are approaching that point within the next 3 weeks. That is not a guess. That is not an estimate. That is a mathematical projection based on current inventory depletion rates, current delivery demand trends, and current counterparty stress levels. The end of the month is not an arbitrary deadline. It is the moment when their models show that the stress on the system exceeds the structural integrity of the market. It is the moment when the building stops swaying in the wind and starts actively collapsing. And they want every single dollar of exposure cleared from their books before that moment arrives. This is why the memo is so urgent. This is why they are willing to accept losses. This is why they are burning revenue by refusing new business. They have done the math, they have run the simulations, and the answer that came back was unequivocal. Get out now. Get out completely. Get out before the doom loop reaches critical mass and tears the entire system apart. If you are still watching, still listening, but still harboring doubt in the back of your mind, I understand. Skepticism is a survival mechanism. It protects you from charlatans and fraudsters who profit from fear. But there is a difference between healthy skepticism and willful blindness. And right now, you need to understand that what Morgan Stanley is doing is not unprecedented. It has happened before. And every single time, those who recognized the warning signs and acted on them preserved their wealth, while those who dismissed the warnings were destroyed. Let me take you back to March of 1980. The Hunt brothers, Nelson and William, had accumulated a massive physical silver hoard. They had cornered the market, driving the price from $6 an ounce to nearly $50. The commercial banks, including the predecessors of today's giants, were caught on the wrong side of that trade. They were hemorrhaging money. They faced billions in losses that threatened their very existence. What happened? The exchange changed the rules overnight. They implemented what they called liquidation-only trading. You were allowed to sell your silver positions, but you were prohibited from buying. This one-sided rule crushed the price, destroyed the Hunt brothers, and saved the banks. The people who saw the rule change coming, who recognized that the exchange would protect the system at any cost, got out before the trap was sprung. The people who believed the rules were fixed, who trusted that the market was fair, were annihilated. Morgan Stanley remembers 1980. They were there. They know that when a market breaks, the authorities will intervene. They will change the rules. They will pick winners and losers. And the losers are always the ones who did not see it coming, who did not get out in time, who believed that fairness and rules would protect them. Fast forward to 2008. The mortgage-backed securities market was showing cracks. A few banks, the smart ones, recognized that the entire edifice was built on fraud. They started selling their positions. They took losses. Their competitors mocked them for leaving money on the table. But then the collapse came. Bear Stearns evaporated. Lehman Brothers ceased to exist. The banks that had exited early survived. Some of them, including Morgan Stanley itself, came within hours of collapse before emergency intervention saved them. Morgan Stanley learned the ultimate Wall Street lesson from 2008. When you see systemic risk, you do not wait to be proven right. You do not hold your position hoping for a better exit. You get out, you take the loss, you preserve your capital. Because being right and being broke is still being broke. Now look at 2022, the nickel market. A massive short squeeze sent prices from $20,000 per ton to over $100,000 in a matter of hours. The London Metal Exchange panicked. They halted trading. And then they did something unprecedented. They canceled billions of dollars worth of trades. People who had won, who had been on the right side of the trade, who had profits sitting in their accounts, had those profits deleted. The exchange literally reversed history to protect the insiders who had been caught short. Morgan Stanley sees the same warning signs in silver today. They see a market where the shorts are trapped, where the physical metal is running out, where the paper claims far exceed the available supply. And they know from decades of experience that when this kind of pressure builds, the authorities will step in, rules will be changed, winners will be turned into losers to protect the system. And they refuse, absolutely refuse, to be holding any exposure when that moment comes. Now let me address the skeptic directly. I know what you are thinking. You are thinking that you have heard warnings like this before. You are thinking that people have been predicting a silver squeeze for years, and it never materializes. You are thinking that this is just another attempt to generate fear, to drive clicks, to sell you something. That skepticism is the trap. It is the precise mindset that allows the smart money to exit while you stand still. Every major financial collapse in history has been preceded by warnings that the mainstream dismissed. Every single one. The housing bubble had its skeptics. The dot-com bubble had its skeptics. The 1929 crash had its skeptics. They all said the same thing. It has not happened yet, therefore it will not happen. And they were all destroyed. The fact that the squeeze has not happened yet does not mean it will not happen. It means the pressure is still building. It means the spring is still being compressed. And when that spring releases, it will not do so gradually. It will explode. That is the nature of systemic breaks. They go from stable to catastrophic in an instant, with no warning and no opportunity to react. What is the risk of being wrong by following Morgan Stanley's lead? If you exit paper silver and nothing happens, what have you lost? You can always buy back in. You might pay a slightly higher price. That is the cost of insurance. But what is the risk of ignoring this warning? If Morgan Stanley is right and you stay in paper, you could lose everything. Your positions could be liquidated at prices you did not choose. Your profits could be canceled by an exchange desperate to save the system. You could be left holding worthless contracts while physical silver becomes unobtainable at any price. The risk-reward calculation is clear. When the smartest, most informed, most sophisticated players in the room are running for the door, you do not sit in your chair wondering if they know something you do not. You get up and you move. You now understand what Morgan Stanley knows. You understand why they are running. You understand the 3 crises converging and the doom loop accelerating. The question that remains is the only question that matters. What are you going to do about it? I am not here to tell you what to do with your money. I am here to give you the information that allows you to make an informed decision. But let me share with you the framework that institutional risk managers use when facing exactly this kind of scenario. This is how the professionals think. This is how you should be thinking. Step 1 is to identify your exposure. Look at your portfolio right now. Do you own silver? More importantly, how do you own it? If you own shares in a silver ETF, you need to understand what that actually means. You do not own silver. You own shares in a fund that claims to own silver. If the fund is forced to liquidate, if the custodian fails, if the exchange halts trading, you will receive whatever the liquidation value happens to be. That could be significantly less than the current price. That could be zero. If you own silver in an unallocated account, the situation is even more precarious. Unallocated means the metal is not specifically assigned to you. You are a creditor of the institution holding the metal. If that institution fails, you get in line with all the other creditors. You might get pennies on the dollar, you might get nothing. If you own futures contracts, you're holding a promise that is only as good as the exchange's ability to deliver. And, as we have established, the exchange cannot deliver 123 million ounces when they only have 30 million. Your contract is a claim on metal that does not exist. Step 2 is to use the conversion window while it remains open. You have approximately 3 weeks before the end of the month. Your goal during this window should be to convert as much paper exposure as possible into physical metal in your direct possession. Yes, you will pay a premium. Physical silver currently trades at $8 to $15 above the spot price depending on the form. That premium is not a rip-off. It is the market telling you the truth that the paper price is lying about. Institutional thinkers do not fixate on premiums, they fixate on risk. They would rather pay $45 for an ounce of silver they can hold in their hands than pay $30 for a paper promise that might be worth nothing. The premium is the cost of certainty. Pay it willingly. Pay it gratefully. Pay it before the premium explodes to $50 to $100 to premium so high that physical metal becomes effectively unobtainable. Step 3 is to become your own analyst. You cannot rely on the financial media to tell you when the crisis is reaching critical mass. By the time the headlines appear, the exits will already be jammed. You need to monitor the data yourself. Check the COMEX vault reports daily. They are publicly available. Watch the registered silver category. If you see it fall below 25 million ounces, you are entering the danger zone. Below 20 million, an exchange default becomes not just possible, but probable. Watch the delivery notices. When the percentage of open interest standing for delivery exceeds 10%, the pressure on the system is becoming unsustainable. Watch the physical premiums. If you see dealers charging $20 or more above spot, the market is sending you a message. The paper price is no longer connected to reality. Listen to that message. Step 4 is to prepare mentally for extreme volatility. The paper price of silver in the coming weeks is going to behave like a wounded animal. When the shorts cover, you will see violent spikes. When the longs liquidate, you will see violent crashes. These movements will trigger stop-loss orders across the retail trading universe, amplifying every swing. The volatility will be designed to shake you out, to make you panic, to make you surrender your physical metal for paper, promises that will soon be worthless. If you are holding physical silver, ignore the spot price. It is a fiction. The only price that matters is the replacement cost. Ask yourself what it would cost to buy back that silver if you sold it. When dealers are sold out, when delivery times stretch to weeks or months, when premiums are $30 or $40, the spot price becomes meaningless. Hold through the volatility. The people who hold physical metal through this transition will emerge on the other side with purchasing power that paper holders cannot imagine. Let me leave you with this. We are living in the gap. The period of time between when the smart money knows disaster is coming and when the public feels it. If you look at the financial news today, everything seems normal. The pundits are discussing interest rates and employment data. The markets are open. The prices are moving in ordinary ways. This is the illusion of normalcy. It is the calm before the storm. Beneath the surface, billion-dollar positions are being quietly unwound. The vaults are draining. The delivery demands are mounting. The counterparty stress is building. And somewhere in a secure conference room in a Morgan Stanley tower, executives are watching screens that tell them the end is approaching. They have given you 72 hours head start. That was 72 hours ago. The lead is shrinking. The crowd is starting to sense that something is wrong. Soon they will move toward the exits, and when they do, the stampede will begin. Do not be in the crowd when that happens. Do not be the liquidity that allows the insiders to exit at your expense. Do not be the one left holding paper promises when the paper burns. The countdown has started. The end of the month approaches. The silver market as we know it is living its final days. What emerges on the other side will be different. Those holding physical metal will have purchasing power. Those holding paper will have regrets. Morgan Stanley is out. Their clients are getting out. The question is no longer what they are doing. The question is what you are going to do. The exits are still open, but not for long. Use your time wisely, because when the doors close, they will not reopen. This is not a prediction. It is a documented mathematical, inevitable conclusion to a broken system. The only variable is whether you recognized the warning in time, whether you acted while action was still possible, whether you chose to be among those who saw the fire before the smoke became visible to everyone. The decision is yours. Make it now, make it wisely, and make it before it is too late